Hi, my name is Jeremy Bush, and this is Jared Van Vark, and we're with Keystone Financial Services here in Loveland, Colorado. And this video is part of our educational series on the basics of finance. Jared, what's your question for us today?
Well, Jeremy, I've got a good paying job here. I'm starting to make a little more money than I've kind of ever made in my life. Everyone's always talking about their investments and, oh, I made this much money here, and oh, I lost this much money here.
Mm-hmm.
I'd really like to be a part of that, and I know it's important to grow my wealth for the future so I can retire one day. Where do I start? How do I know what to invest in?
Absolutely, that is a great question. So the basics of really where we want to start is knowing a couple things about yourself, okay? Mainly, what is your risk tolerance and what is your time horizon? And really what a risk tolerance is, it's literally just as it sounds. It is your tolerance towards volatility in the market, okay? Now the market is always going to do this, okay? Ups and downs. Over time, it's going to do that, all right? History has shown us that. But there's always going to be ups and there's always going to be downs. So these short terms, ups, downs, like that, that's basically volatility of the market, okay? That's caused by a number of things and there's no way around it. It's just what happens, okay? Now your risk tolerance tells us basically how sensitive to this are you. You're going to be the person who's watching it every day, who's like, oh, it's up 300 points today. Fantastic. I'm cloud 9. The next day it's down 200. And you're like, we're all going to hell in a handbasket, okay? And people are all over the place. Some people are very aggressive. They don't mind these, knowing that they have a long-term view, which is where the second one comes in, time horizon. Now you have this in your corner, okay? The biggest factor that we can never reproduce once it's gone is time, all right? So you're a young guy getting out of college, just ready to get started. You have probably the longest time horizon of anybody, okay? You got 30, 40 years, maybe more depending on how much you love your job, that you have to start packing money away and just let it grow, okay? Which basically means, like for instance, the shorter the time horizon, the much less risk you probably want to be taking, less volatility you'd be comfortable with, because you know that money's going to have to start serving you a lot sooner. Whereas, like I said, you can start putting away and not even think about it for 20, 30 plus years, all right? So knowing those first two things, that's where you're really going to establish, okay, what kind of investments are right for me then? And that's where we kind of get into an asset allocation model, all right? So we know your risk tolerance, we know your time horizon. So what does that mean? Well, a lot of people think playing in the stock market is really just picking stocks. Like, well, I know Coca-Cola. I want to buy Coca-Cola. Okay? I know Facebook. I know Amazon. I want to own them. All right? Nothing wrong with owning individual stocks, but you just don't want all of your money in just a few stocks. Okay? Say it's happened in the past before. Most recent example I can think of is GE. GE is one of those companies that everybody thought this company is going to go forever. They're going to be around forever. Every company is susceptible to it. One thing happens wrong and the entire thing comes crashing down. And then all of a sudden you have all of your money in Coke or Amazon or Facebook. Now it's worthless. All right? That's where a good asset allocation can come into play. Now, what do I mean by asset allocation? Let's think of a pie chart. Okay. All right? And so in this pie chart, we have a couple different asset classes. Now, asset classes are things like stocks and bonds, okay? Mutual funds, index funds, those are all known as equities, okay? And so equities are the types of things that are a lot more susceptible to these ups and downs, okay? That's where you're going to get a lot of the growth and a lot of the drops in value, especially over the short term. But the fact of the matter is, and what the markets have taught us over the last 50, 60 plus years is that equities are really where all the growth comes from, okay? Things you have down here, this little section, what we like to call is kind of a irreplaceable capital, okay? That's money that we don't necessarily want to risk all that much, okay? So we're always going to have a certain percentage of this in irreplaceable capital. This is going to be more fixed income things, bonds, maybe even notes payable, various debt instruments, things like that. They don't really move very much, and they tend to hold their value a little bit better, okay? That's not to say they're never going to go down in value, or they're never going to go super, super far up in value, but these are a lot more stable, okay? So that's kind of, think about it as like the ballast in a ship. That's what keeps the ship afloat, okay? And so this is where all your growth is going to come from. So a good asset allocation is going to be very dependent on your risk tolerance and your time horizon, okay? For instance, a very, very aggressive investor, right now it looks like I have this set up for about a 75-25 split right there. That honestly would be, for most people, that would be fairly aggressive. 80-20 is very aggressive. The more you lean towards equities, the more aggressive, the more volatile your asset allocation is going to be, okay? The bigger piece of the pie that this irreplaceable capital section gets to be, kind of the safer, the less volatile. It's not going to grow as much, but it's going to be more protected over time,
Gotcha.
okay? So various allocation percentages we can do there, and obviously this is very simplified. We have many, many different asset classes out there, but this kind of shows you that yes, it's certain percentages that we put together in certain ways that match up with your risk tolerance and your time horizon.
I see.
Okay.
All right, gotcha.
And now you might still be thinking, well, this is fantastic, and I get it, and I want to invest, but where do I start? And honestly, this is where a good financial advisor comes into play, okay? A financial advisor is going to do a couple of really good things for you, okay? One, they're going to establish this risk tolerance, all right? Most financial advisors out there, if not all, have some kind of risk tolerance questionnaire that will help you gauge where you're at. It's usually very simple, a few questions, put you in the right area, okay? Time horizon, they'll also be able to help you out with that. That's a lot more simple, how soon are you going to need your money, how young are you, how old are you, etc. But then the combination of those will tell us where, what kind of percentages we should be using here and how best to maintain that diversified portfolio for you while still getting you that growth.
I see.
Okay?
Gotcha.
The other thing an advisor does for you is keeps an eye on these over time, because over time, as your situation grows, so does your tolerance towards risk. Your time horizon gets shorter, okay? So these things they're kind of living things, all right, asset allocations. We rebalance them from time to time to make sure that it's still part of that allocation, but at the same time, we're gonna shift these as well as you get older and as you get closer to retirement, start protecting more of that money that you've grown over the years and advise you accordingly.
Gotcha.
All right. Now, the other important part, and the last thing I want to talk to you about today is, so you're saying I need an advisor, how do I choose one? All right. A few basic things. There's a lot of people out there in this business nowadays. I can think of probably 10 to 15 within a couple miles of this building. All right. Now, the important thing to remember, just a couple things, is always work with a fiduciary. Okay. And a fiduciary is someone who literally has the legal obligation to put your interests first as an investor, okay? Now really what you want to be looking for then, if you're looking for a fiduciary, is someone who is a CFP, or a Certified Financial Planner, all right? Because they hold that designation, they are in essence required to be a fiduciary, all right? So there's kind of basic things there, kind of look for that. Definitely, if, more than anything, I'm sure your mom or somebody knows they have a financial advisor. Look for personal referrals from people if they've been working with someone for a long time, someone who has a good track record with this, treats people right, things of that nature.
Gotcha. Awesome. Well, thanks for all the explanations today. This is starting to feel like a little bit more of a clear picture, so hopefully I can take it places.
Glad to help. Absolutely.